So many at this stage are sounding so optimistic about the week ahead. What's your view on the markets at the moment and the sustainability of any positive trend moving forward?
Good morning, Alishia. Thank you for that question. Primarily, the audit, the completion of the audit by the CBN has more or less calmed frayed nerves, essentially with respect to the banking sector, which has likely been the driver of the Nigerian market. What we've seen essentially is a situation where, particularly if indeed the plans to set up the asset management company is concluded in good time, which as proposed by the CBN governor, he's looking at the window of completion of sometime by end of December, would hopefully take off the toxic assets, that portion of toxic assets from the books of the banks and then transfer it to this asset management company, thereby freeing up the banks essentially to be able to lend going forward. What that has done, it has essentially put some kind of positive clarity in terms of direction as to perspective on the banks. Now, this is irrespective of the fact that in the course of the last week and a half, we've seen numbers from the banks for Q3 or September of this year, with a good number of them declaring losses. Obviously, given the huge provisioning levels we've begun to see, but I think positively overall, we anticipate that within a year and a year and a half, we should begin to see some healthy returns from the banks.
In that context, I've been reading market reports suggesting that bidding up the banking stocks would certainly be a reasonable move by investors, as most of the banking stocks currently trade at an attractive discount to their fair value. How are you playing the banking space right now?
Yes, indeed. Given the current valuation of the banks, where a good number of them are trading at anywhere below 0.5 times their book value, they are indeed looking attractive. However, it's important to note that not all the banks essentially would make a fair attraction. What we're looking at essentially is a situation where we anticipate that there are at least two broad classes of these banks, that is referring to the ones that are listed, those that have been declared healthy, and those that essentially fail the audit. What would see essentially is a situation where the guys who pass the audit are largely expected to be the guys who would drive the sector going forward. This bearing in mind the fact that we're anticipating a new round of consolidation, we would expect that at least some of these guys essentially would make it through. The likes of First Bank, GT, UBA, Zenith would expect essentially to drive the sector going forward.
Victor, for now though, there's a lot of interest being diverted towards the non-financial space, especially when it comes to local investors. So let's shift focus to the consumer goods sector. We saw recent results reveal that GlaxoSmithKline saw a 47% increase in profit after tax. It's invested in 2 gas power generators as well to meet growing demand for consumer healthcare products and pharmaceuticals. What's your view on GSK right now?
GSK is a fantastic story. It's one of our key stocks. We had earlier in the year anticipated that it was going to do well. It has indeed come in line with our expectations. In fact, it's actually in some ways exceeded some of our own targets. I think one of the things we're going to see for the consumer goods sector is the situation where a good number of them have have made huge investments, both in terms of capacity expansion as well as in sustainable power generation on their own. They've basically diverted their power generation to gas pipelines, and I think the outlook is positive, particularly given the recent amnesty program and the stability and the peace that has essentially come to the region. Therefore, implying that gas supply and gas availability shouldn't become a major constraint in terms of vandalism. I think ongoing plans also by the government essentially to through the gas master plan, harmonize gas fiscal terms should also positively impact production costs. Many of them have also gone on to begin, essentially what we would call, cost control measures, cost containment, and they've become more efficient in their operating, metrics. So that is going to trickle down to the bottom line as well.
What's interesting though, Victor, is that while we've got GSK talking of heightened demand that's warranting this investment moving forward, we had Nemeth when it released its results recently as well, attributing its poor performance to a decline in demand. So why is there such a different story being spelt out for Nemeth?
I think essentially it follows on from the strategic focus of the firms. Whereas GSK has grown from being a main pharmaceutical play, and has begun to diversify into what it terms nutraceutical, in which case they look at health foods and health products, and in some cases other just general cosmetic services and such like. Nemeth largely remains a pharmaceutical play, essentially drugs, medication, and of course given issues surrounding operating costs, and then also looking at the Nigerian pharmaceutical terrain, or where essentially the production of this drugs and medicines rely heavy on imported substrates and chemical substances. That has obviously impacted them. There is a lot of competition from the importers of medicines and pharmaceutical products, who largely import this from the Far East, India and China specifically, at extremely low cost, given the low production costs that they have over there, and therefore this is also a major issue for them in terms of competition.